Well, hello and welcome to our next instalment of Nucleus Insights, entitled the Self-Managed Super Fund Summer Clean Masterclass. We sort of missed spring a little bit with getting Nucleus Wealth up and running, but we think it's a pretty good time to take some time, I guess, over the summer break to reflect on perhaps how your self-managed super fund's been running. We did also receive some feedback from some previous webinars that a few of you would like us to focus a little bit further on various bits and pieces and things that we can offer in the area of self-managed super funds. So here we go. Just before we do, of course, we've got the disclaimer. Just a quick reminder that the following presentation is general information only. And whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional or financial advisor before making any decisions discussed in today's webinar. Sure thing. So myself, Tim Fuller is my name. I'm a certified financial advisor and have worked for many years in the retail space, working with mum and dad clients, small and large accounts. Worked for some of the majors, and also in the last couple of years have been working predominantly in the self-managed super fund sector. So I feel like I've got a bit to add today, which is I'm really looking forward to delivering. We've also, sitting across from me, got our head of investments for Nucleus Wealth, Damien Klassen. Outside of course, working for the number of big firms there, Schroders and Wilsons, and also being the founding partner of a stock and analyst research firm called Aegis. He is also the proud owner of a self-managed super fund. So I'm looking forward to hearing insights today. Good afternoon to you, Damien.
Hi, Tim.
Sure. So what are we going to move into today? Well, look, we're sort of looking at, I guess, where to begin. So certainly, as a trustee of a self-managed super fund, where to look for reports and how to put together some facts and figures and really, I guess, get the pulse on your self-managed super fund. Then, of course, looking at areas such as performance, which is typically one of the main reasons why people go into the self-managed super funds to make some money, of course. We'll run through some our take really on fees and brokerage and accounting, and I guess offer some reflections on where your account might sit in basis or in comparison to what's out there in the market. And then finally, we're going to do a bit of a deep dive into asset allocation, which of course is one of Damien's fortes. We're going to run through 5 major mistakes for the self-managed super fund trustees that they often make in by way of asset allocation. And then, of course, we'll recap with our view on the best practice for that. Just before we do kick off, though, I just thought I'd just launch into a brief little rundown of self-managed super funds in Australia, basically the landscape. And if you want to have a further look into this, we've got an article up in the research page of nucleuswealth.com. But look, I guess a couple of key facts that came out of a recent ATO report, which they put out on a quarterly basis, so the figures are reasonably fresh. One of them, of course, is that whereabouts does the typical SMSF investor sit in regards to age. So as you can see there, the vast majority sort of sit between the 45 and the 75-year-old range, which from my experience is pretty typical. You more or less find people as they sort of get into concentrating more on what's going to happen post-retirement. Generally, once a person turns sort of 50, they start wondering, have I got 10 years left to work, or if this is going to be 15 or is it going to be 20? And so this is where the move into the self-managed super fund range sort of makes sense for some people. And obviously at that point, they've typically got enough assets that qualify as being able to open one. So it's nice to see that the figures sort of reflect my experience in there. Another one, which was actually probably a bit larger than I thought, was the amount of people that are in self-managed super funds. So obviously, a self-managed super fund can have no more than 4 or less than 5, is the ATO terminology. And what's staggering there, of course, is that 70% of all the funds in Australia have 2 members, which once again I think lends itself to my experience, which is your mum and dad typically, maybe a couple of brothers perhaps on the odd occasion, but vastly it's a husband and wife sort of situation that are getting into this. And of course, then as trustees of basically their financial future, how they're going forward. And I guess it's one of the main reasons for putting this together today. Just finally as well, while we're on the stats from the ATO report, the just to give you a bit of an idea of where, well, the size of assets that are in the average super fund. So as you can see there, the vast majority, near on half actually, are between 200,000, sorry, and $1 million. And what I've used just for some comparisons a little bit later on is I've pulled out a subset of the between 200 and 500,000, which is, once again, your sort of maybe typical balance you could probably find for a mum and dad investor to have in a self-managed super fund. And then what I've done is I'll add in some figures from the 2 to 5 million range, which is obviously significantly 10 times bigger, where you more often than not you'll find some professional management over, say, the mum and dad investors there. So stay tuned for that. We'll roll into reporting, and I guess, look, for most people, it depends on what sort of relationship you sort of have with your self-managed super fund. Obviously, as the trustees, you're in charge of it, but at the same time, you more often than not you probably find that you're relying on at least a couple of professionals, at least one being your accountant that puts together the bulk of the tax returns and the information that needs to be submitted from a tax perspective. Where this can sometimes be a bit of a grey area, of course, then is then internally reporting back to yourself. So what I mean by that is the reports that I've seen and when working with many accountants and plenty of self-managed super funds is that they can make pretty reasonable sense to a professional in terms of being, getting an idea of quantifying what sort of tax position a self-managed super fund would have. However, the key statistics that you might want to pull out to see how your investments are actually faring along, year on year, can be a little bit harder to glean from these tax statements. And look, I suppose that the takeaway of all this is that you need to start, if you're not doing this, you need to start looking at creating some sort of a document for yourself, be it an Excel spreadsheet or an exercise book if you're not too keen on working in Excel or with a spreadsheet. But it's about creating a basis on which you can say, okay, well, look, I've got a variety of assets in my fund, for example. I might have some cash, Australian share investments, property, etc. And what are my sort of cost bases, and how well are these? How well are these going? So I might just quickly pass over to Damien just to get a couple of insights.
One of the things that I really notice on what I get back from my accountant is they'll mix in the contributions I've made, and because that's what they're looking at from a taxable perspective is what's my contributions. And so from just looking at the raw numbers, you're sort of looking at it going, wow, that's a nice increase, and you go, oh, just a minute, no, that's got my contributions in there as well. I need to strip that out before I need to actually go back and work out the underlying figures. And as I said, as Tim was saying, it's largely done as an accounting exercise, and which is very different to how you should be looking at it from an investment perspective.
Sure. Yep, absolutely. And I guess forwarding on from that, when you are looking for key statistics, and in order to make a quality assessment, obviously one is certainly the bottom line. And for those that have worked perhaps in management in business, you're always fairly keen to see what went in and what came out, and therefore what's the overall benefit. And it can be a little bit harder to glean from these tax statements. But look, we've sort of chucked some loose ones down, and I think, look, this isn't the be all and end all, but if you're working with nothing, this is certainly better than nothing. You've got something there. But really looking as Damien said, to adding in any withdrawal and pension payments. Obviously they've come out throughout the year, but obviously subtracting contributions as well, which I wouldn't say artificially inflate the balance, but they certainly don't reflect too well on your investments. And look, this is where it can be quite tough, because if you put regular contributions in vis-a-vis your SG contributions from work or any other concessional contributions that you've put in along the way, are they being invested or are they sitting in cash? And it can be reasonably difficult to really pull down a really good picture of that. But at the same time, if you can chuck it in a few buckets, and this is where an asset category breakdown is fantastic, and you may need to just speak to your accountant perhaps in the formation of those, and they might charge a bit extra. They might decide to do it for you, to because they're interested perhaps as well in seeing where it's all going. But I guess ultimately pulling out from the various portfolios you might have, or if you want to go down to the various sectors perhaps in what you're investing in as well, but knowing exactly what's doing well and what's not is pretty key to making an assessment on how well you're going. Thoughts there, Damien?
Yeah, absolutely. And I think the trick with some of the asset category breakdowns, from my perspective, because I perhaps care a little bit too much about this than being a quant analyst, but there are and they are getting better. But what I have seen in the past is that the default breakdowns you get are often misleading. So what you might find is exchange traded funds in particular. You might have bought an exchange traded fund that's a bond fund, and so quite a low risk fund, and that might end up being reported in a lot of people's software as being an equity fund. Or your international equities get reported as being Australian equities because you bought an exchange traded fund that was listed in Australia. And so, actually getting into those holdings and working it and making sure they're all being added up correctly, because the default software may not actually be classifying everything the right way.
Okay, so not just relying on an automated sort of statement.
Well, at least sense that's right. At least sense checking the numbers you're getting out of there, just to make sure, and just a few big categories, just to say, let me just check my bonds and let me check anything that's an exchange traded fund or a managed fund. Just make sure it's being allocated into the right category.
Great point. And I guess on the other side of the coin is then, and we'll touch on this in a moment, but the having a bit of a look, obviously, at the fees and costs and other expenditure. Now, look, one of the benefits of self-managed super funds is that you can deep dive quite granularly on the costs that are in there. Sometimes they're bundled in, and we'll touch on that in a moment, but I guess the main thing is getting a reasonably broad picture on some key areas, and I've listed a couple there: advice and management, audit and accounting costs as well. More so that you can just keep an eye on these sort of costs, because like anything, they can excuse that. Sorry, like anything, they can blow out, rather quickly, and surreptitiously, I guess, at the end of the day, and it's just sort of something that if you don't keep an eye on it, it could be something that's detracting from your overall performance in a rather large way. Yeah. So,
and the main thing I'd like to hit on those ones is there are a number of costs that are hidden, and brokerage is often one of those costs. So a lot of people will put that in, and especially if you're going through people where that is one of their key revenue lines, you might find that the brokerage just gets priced into a lower purchase price or a lower sale price. So that gets hidden. So let's say you've got $10,000 worth of stock that you've just bought. What'll end up happening is you'll only buy $9,900 because they've hit you up $100 for brokerage, and you don't even see that in your final reports or anything. All you see is that, well, this is how much stock you bought, and this is they price it as if you just bought it at a lower price. And so, while that after a few years that all washes out, certainly some of the higher turnover accounts, you can really lose that in the reporting. And the other one is the fees on exchange traded funds. And they're not usually big, but some exchange traded funds do have big fees. Often you find they're hidden within the fund as well, and you do find within managed accounts and managed funds and unit trusts. There are a lot of costs that you don't see within that, whether it's their own internal audit and accounting and their own trading. That all gets hidden again from you. So that you get reported the final number. They'll usually tell you what the management expense is. So they'll say, well, you've paid whatever 75 basis points in management fees. What they don't usually break out is that extra fee that you pay in terms of the trading and the the accounting and audit and legal and stuff like that just gets bundled into a lower unit price. So you may actually be paying, if you've got a 75 basis points, you're paying a management fee. There might be another 25 basis points or more that you're paying in these other costs that you never see. That's just presented to you as a lower return.
Okay, sure. And I guess, without sort of making this all seem too hard, ultimately, I guess the point of today is to really say, well, look, how about we just sort of break it up into some digestible chunks, with the idea is that you can focus in further once you're happy with where you're at. Exactly. Yeah. So, absolutely. So look, I guess just in summation for the reporting as well. So some questions sort of to quickly ask yourself. Look, number one is, and this is coming from putting my planning hat on, but just a quick compliance one is obviously the investment guidelines in your trust deed. Self-managed super funds typically get started at a certain, time in your life, perhaps, or with a certain aim. It could have been many years ago, and look, obviously, perhaps to get picked up in audits. Sometimes it does, sometimes it doesn't. But it can pay just to review your investment guidelines and see whether or not you are actually within those. the ones that I've seen are normally quite broad, so it's not a huge area of concern. But the big thing is, older funds in particular that have been set up, for example, for investing in a property or something, and you've gone into an equity sort of position over the years, perhaps may not be 100%, within those guidelines, and it needs to be adjusted. It should be fairly easy fix.
And it is worth talking and thinking through these processes yourself. I mean, the investment guidelines were meant to be there from a regulatory perspective. They were meant to be there for a reason, to say to people, well, you line up, what do you think you should have in equities and bonds and these things like that, and then let's run it, because that's the way a professional investment manager would run, is that they'll be given limits. They'll be told, okay, you can only buy this much equities for this client account, and you can only buy this much bonds, and because they have a certain risk profile, and then the manager will go out and try and perform to that standard. What does tend to happen with a lot of SMSFs is they end up with being, you'll be 0 to 100% equities and 0 to 100% bonds and whatever, and go for your life. Whereas you really should be coming back to whether, ideally you're updating your trust deed, but even if you're not updating your trust deed, is that you've actually got your own guidelines that you're saying, well, my plan was to have whatever between, I was a balanced investor. I was planning between having 50% and 80% in growth assets, written down somewhere that you can keep coming back to yourself, whether it is your trust deed or not, but you can keep going, well, if I'm outside that band, I should be getting myself back into that band. It might be I'm accumulating too much cash, or it might be that I've the markets have run really hard and I've just got a bit excited, and I've gone over that 80%. I need to keep they're there for a reason. They're there to help govern you in the times when you do get too excited or you get too scared about the market. Having those investment guidelines is very important too.
Pretty key sort of part of keeping it all together. Yeah, look, absolutely. And I think the other side of that is and this sort of harks back to, I think, a little bit to our first point there, but the keeping a bit of a history on where you were invested and what it's returning, and then ultimately keeping a timeline of the decisions that you're making in the fund. So obviously, being in complete control of it yourself as a trustee, you come into it for certain reasons or with a certain goal. Over time, as I've seen time and time again in life, things change. Lifestyles pivot, or new plans are made, and I guess bringing that back to an investment sort of reporting sort of perspective, having a timeline of saying, okay, well, look, we've moved into, for example, resources prior to 2007, whatever it is, and then saying, okay, well, has that run its race? Do I need to rebalance, as you say? Am I outside of my my guidelines that I've set myself at at that point in time? And does this give me, I guess, an impetus to sell down and start looking for something else?
Absolutely, and whether it's stocks or whole sectors, is one of those behavioural economics things that people get overwhelmed by, and it happens to everyone, and the professionals as well as the amateurs. And the idea for professionals is we make sure we write down all this stuff so that we can come back to it and revisit later, because your view on things change. And it's usually things like there's a value stock, and I'm buying this because it's cheap. I don't think it's actually that good quality, but it's just so cheap that it's worth it. And it's worth buying now. If that thing doubles, in most people's minds, all of a sudden it's a high quality because it's just doubled. Obviously the price has doubled, so it must be high quality. And all of a sudden it turns into this, oh, you're now going to own this thing forever. And it's those ones where you've actually written down, look, I don't think it's a high quality stock. I think it's just a value. This is just a value player, or we're investing in, an emerging market because of some sort of growth expectation or something like that. When it occurs, you can then come back and go, well, this is why I really do need to think that maybe there's other assets I should be flipping back into.
So essentially, you've achieved the goal, you've made your 20, 40, 100%, whatever it is, and then having something that was written down like a letter to the future self saying, hey, don't forget to sell this at some point, because
exactly. Don't get too excited, don't fall in love.
And off you go. All right, fantastic. Just I guess the next stage, once you've got the reporting under control and you're pretty happy that you've quantified your performance figures. What I've done here is just jotted down some average returns just for the last calendar year or year to date from today. this is more just, I guess, just to give you a bit of a guide on, particularly from the, from a share perspective, which is what we do every day, some of the returns that have come through. I'll give Damien a little bit of time to maybe just have a quick chat around some of these, if you wish, and then we can move on. But
yeah, look, the key thing is to have a benchmark. And to make sure those benchmarks, accumulation index, knowing whether you're dealing with an accumulation index or a straight index. So the straight index is just the price movement. The accumulation index is the price plus the dividends.
Very good.
And depending upon who is calculating it, it may or may not have some tax. Someone like MSCI do a few. They do a gross one and a net one, and there's different things about how much tax is. But in broad sense, you should be able to, within your portfolio, say, my portfolio plus the dividends that I got me from here to here. You should be lining them up against an accumulation index, not just a straight index. So the index you hear, the ASX 200 index, that's not the one you want. If you're including dividends in your own performance, well, you need to make sure that the index has got dividends in it. So look for the accumulation index that does include those. And then and basically these are all what you call market cap weighted. So the biggest stocks make the biggest difference to these indexes, which is going to be different to the way that you invest, but it's probably going to be pretty similar to the way if you're employing people like ourselves or you're employing other fund managers, they'll be benchmarked to some sort of index. And so working out, what are they actually what are they lined up against? So there's a few others that you might be interested in, things like the small cap. There's an Australian small cap index, which is everyone from the ASX 100 to the ASX 300.
Okay.
That's a pretty common one that most people sort of, especially if you're dabbling in small caps, you might be looking. There generally isn't too many indexes on micro caps, which is a really small end of town. So once you get into the sort of 20, 30, 40, $50 million stocks, mainly because those are so volatile and having a whole portfolio of them is actually quite difficult in terms of the management of those.
Okay. Sure. And I guess then looking at the other side, which we've only just we'll just briefly touch on, but that was if you're holding property inside of your SMSF, obviously quite a popular strategy, has been for many years. Look, you don't, from the ATO, you don't need to get valuations done on them on an annual basis when you do your returns. However, in my experience, it is not a bad idea to get one sort of every few years. I've got down there 3 to 4 years as a bit of a guide, just purely because it's like getting the performance figures from everything else in your fund. It's nice to know what your assets are worth in there.
Yeah, and the other thing I say is there's a number of sites out there that do valuations, I think onthehouse.com.au and a few others like that will do sort of rough valuations. They're sort of quantitatively calculated on, and they'll tell you what's happened in your suburb and things like that, where you may not need to have an official one done, but at least you've got a rough guide that, everything else in my suburb's up 3% this year or down 5%. So at least you can sort of have a rough idea about what your property is going to be doing. Yeah,
sure. And I guess then obviously there's a range of holding costs and ongoing costs with property as well. So it is important to look at, obviously, number one being capital growth, one of the big reasons why people are in property, but also then adding in your rental yield, and then of course minusing out your relevant costs. And you might have management fees, and there could be some lending if you've got lending in there as well. And I guess the big thing there is that once again, it's creating an annual, year-on-year picture where, particularly at the moment, where obviously property valuations are quite high, you might be starting to see a bit of a plateau in the capital growth side, and then you're really perhaps looking at rental yields sort of being the only real reason to be in property for the moment. And then of course, once you minus out your costs, you might find cash-like returns, which is
I suspect for a lot of people, if you can get cash-like returns from rental yields at the moment, you're probably doing well.
Yeah, after costs.
After costs.
Yeah, sure.
So very key to have a look at that, because they go through the stages of investment, and if you're investing in something and you're losing money or barely breaking even on your yield, and especially on a property type asset property's meant to be developing a yield, if you're getting negative returns or whatever after your holding costs, then you're basically holding it for capital gains, and you need to have a serious think about are you going to get the same capital gains over the next 20 years that you just got over the last 20 years or.
Absolutely. Yeah, sure. Okay, very good. So we'll dive into fees and brokerage and accounting. So look, I've put a broad, I guess, band here. Now I will sort of preface this, particularly with the accounting and the audit costs, by saying that these are sort of I guess, estimates for in my experience, funds that are typically, they don't hold property and they don't hold a lot of, those sort of external assets that may need audit, higher levels of auditing and higher levels of accounting. So this is just typically your mum and dad fund that might have, a block of Aussie shares, maybe some international ETFs, some cash and some bonds. A bit of a range there, I guess. So online, the online space is incredibly competitive at the moment, and sort of I've been finding them sort of $8 to $9 to about $1,000 a year all in. Once again, though, what they do is, of course, they limit the sort of investments you can have, which is, helps their scalability and their ability to create those really low prices. Middle of the range for me, I'd typically find about 1.5 to 2, maybe 2,500 through your your average sort of accountant, and then right up into, I guess, what they call a full service. I'm not sure what a full service is. I think it's Chocky Bickies instead of the Monte Carlo when you come in once a year. But I won't go too nuts on that. But look, at the same time, 5,000, it's 1% on a $500,000 SMSF portfolio, and if you're adding in some other costs as well, you might find that you are sort of potentially giving away, could be a third, could be a half, perhaps on a conservatively invested fund, back to your service providers, which could mean time for review. From a brokerage perspective, and I suppose brokerage is big for us in the equity space. Look, once again, you can see the band there. So we're obviously using a separately managed account like we do. We can average the brokerage across a large number of clients, which is where we can get it so cheap. Typically in your online spaces, I'm sure many of you are very aware, there's sort of 10 to 30 odd dollars, Aussie and international, you can sort of get around that. Big markets only, US markets, you sort of find that lower amount. And then upwards of, sort of in the $60 to $70 range I've seen with broker relationships and people using managed discretionary accounts. And basically this is where you've got to be a little bit careful, in my experience, because you'll find that the brokerage this is where you get that problem of it being folded into the purchase of the share parcel. And it's not always as evident exactly what you're paying for those. And on larger turnover portfolios, as Damien said, you'll get a pretty significant burn there as well. So, and then finally, for financial investment advice costs. So this is an interesting area, I guess, purely because you've got a couple of components here. You've got financial advice per se, sitting down with an advisor and creating a plan and doing the follow-up work, and implementing it perhaps and having someone to call. But then you've also got the other side of it, which I suppose Damien's side of it, which is the actual investment management, so the research and the stock picking and creating that as well. Now, some avenues combine all of that in sort of one big fee sort of thing, and I've seen the 2% range quite commonly out in the market. And then others will break it out into a financial advisor sort of percentage. It could be 0.2, 0.6, 0.8, 1. And then obviously on top of that, then you've got, okay, well, we recommend these various managed funds, for example, which once again you're probably looking at 1 to 1.5 to 2% in some places as well. So it can be a little bit of a grey area, but it's sort of something to break out. And once again, not trying to denigrate it at all too much, I guess, but at the same time, it's about creating that value proposition and saying, well, look, I am paying XYZ for these services, and really itemising those out there, so you can say, okay, well, am I getting $5,000? Am I getting $10,000 worth of value through these providers that I'm paying, or do I need to ring them up and get them to sharpen the pencil a little bit?
Yeah, and one big thing you've very much noticed in the institutional space over the last few years has been this rise of indexing, and what that's largely about is coming back to saying, if I would go out there and I find myself 10 different investment managers, which is the way, or more, 10, 15 different investment managers, which is the way a lot of big asset firms would do it. They'd find these 10 managers, they'd give them all a bit of money, and then aggregate up all the results, and basically that's what you get. The problem with that is, if you get that many people, you end up getting pretty close to a market average result, because some of them outperform, some of them underperform, and you end up paying active management fees, but ending up with index results. And so what they've now started to come and do is say, well, if I want that, why don't I just put a bulk of my money or a chunk of my money into some of these index funds, or picking some of the low cost sort of core managers like ourselves, to manage that core part of it. And then if I think there's the particular hedge fund who I'm happy to pay 2% plus 20% in performance fees or something like that, because I genuinely think they're gonna make the money for me, then I'll go and put a slice of money in with that. But rather than sort of paying lots of different professionals lots of money and ending up averaging out back to you're getting average performance and paying a lot, he's coming back saying, well, let me find some lower cost ones that can do the core stuff. And now if I do think, I want to invest in small caps, or I want to invest in a hedge fund or something that's going to cost me a bit more, you can do that sort of off to the side and make that a smaller bet, and your average cost across your whole portfolio is in a lot lower.
Yeah, absolutely. And I guess we'll touch on that in a couple of slides' time anyway, Damien. That's a really good point. So we'll jump across now to asset allocation, I guess. And look, this is the fun part, really. It's easy to sort of perhaps skip over this one, but it's probably one of the most crucial parts of investing in any way, shape or form. But I guess with self-managed funds, it's particularly relevant because it's your money and it's potentially your early or late retirement at stake here. Look, I guess there's a note there, making sure your pie is balanced, but and this, I guess, pertains to two things. One's, obviously getting the balance right inside of your fund, but also looking at your overall total family ownership pool or your family asset pool as well, and making sure that, you're not overweight in any area. And this is where you can start getting these, this element of risk coming in on board if that particular asset class does start to get on the nose. So we'll jump into the 5 biggest mistakes that we think of SMSF ownership, and the first one being quite a common one, and it sort of parlays itself into some of the later mistakes. But one thing I've found is doing nothing, and this is not a reflection on poor management. This is probably more a matter of having not enough time, perhaps, which is coming up soon. But obviously, you set up the fund in such a way, in the excitement of running it, it's fantastic year 1, year 2, and then sort of ebbs and flows, and life takes over, and this thing sort of sits by the wayside. But of course, what's coming in generally with most self-managed super funds is your contributions. So you're getting, perhaps you've elevated your concessional contributions to save a bit of tax from your income. So that's dropping in 9.5 or 10 or 12, whatever it is, % of your income, perhaps of your spouse's as well, and that generally will just park itself in a cash account. And then every now and then you might look at it and go, oh, gee, that's a fair bit of cash, and you'll see there with the 2 bands that I've sort of chosen that your mum and dad investors do typically hold higher levels of cash than what you typically say was a professionally managed sort of subset, being in the 2 and 5 mil. And I think that's quite evident in my experience. So probably the first mistake there, certainly to look at is doing nothing, or just not investing is probably a better term rather than doing nothing.
Yeah, and if you add those figures up, if you're sort of 10% in extra cash versus versus equities and other things in the long term. Not saying, yes, there might be short-term tactical reasons to move in and out.
Absolutely.
But in the long term, you're probably going to earn somewhere between sort of 4 and 6% more in equities rather than in cash. And so, that'll, if you've got 10% of your cash there, there's 0.5% per year that's just sort of sitting away, underperforming over the long term. Over the long term,
it'd make a massive difference, sure. And I guess second mistake there is sticking to what you know. So obviously, people like playing in their own patch. This is once again, these stats are from the ATO report, but listed shares, I guess, is one area that people generally have a bit of a feel about. They know the bank they bank with. They know the shops that they shop at. Days gone by. Buying those shares in Australia, might flick the old dividend reinvestments on and then set and forget. But should this always be then translated into larger portfolios, Damien?
No, yeah, absolutely. So I think the idea is that you need to, in terms of asset allocation, you really do need to step outside your comfort zone, and we'll move into there.
Yep. Okay. And I guess the previous one was listed shares. Now, we'll just preface the fact that the listed shares for the ATO report, I suspect, do have some international in there. These are the overseas assets of the report. As you can see, what I've done is I've actually just bundled every overseas category in, and it struggles to make a percent in pretty much in both both sections of our study here. I'd still be led to believe that there is a pretty gross under investment in self-managed super funds in regards to overseas investments. Would you sort of tend to agree with that?
Yeah. So the theory and everything keeps changing, but in terms of how much you should have in Australia versus overseas, we've certainly got a big tactical bent to having more overseas assets than Aussie at the moment. I think it's safe to say that from a sort of strategic version of what's the right long-term level, is that given the Australian dollar acts as a bit of a buffer on shares, is that when the Australian dollar is rising, you're usually finding the Australian share market's rising and international share markets are rising as well. So Australia is an economy that's exposed, that is positively correlated with global growth. And then when you see international markets coming off, quite often the Aussie dollar is then falling, and that actually gives you a bit of a balance. It helps to cushion the downside. And so what that means is that international assets are quite attractive from a risk return perspective for Australian investors. And so most sort of people have from a strategic perspective, you should be owning roughly about the same amount of overseas assets. For a more growth-oriented investor, you should be owning roughly about the same amount of international assets as what you do Australian assets. And so, what that comes back to is most smaller portfolios are nowhere near that. They're fully, chasing franking credits and chasing sort of, what we know in Australia, and sort of ignoring this huge sort of international.
Got essentially a myopic sort of domestic bent, chasing the dividends. And of course, the other thing is, just in stock picking in general, Damien.
Yeah. So there's a couple of books out there. Peter Lynch is quite popular for them, sort of Beating the Street and One Up on Wall Street. And his whole philosophy comes back to invest in what you know about. If you shop at this shop, then you can go invest in that, and you'll learn. You'll beat the market by finding your own niche and finding things you know about and things like that. Now that's fine for stocks. What my contention though is that's and he's very clear that what he's doing is out there trying to tell people how to invest in stocks. Asset allocation is different. Asset allocation is literally about diversifying your money and finding different uncorrelated assets. And so almost by definition, you can't know everything about everything. And so you do have to sort of step outside your boundaries, but work out where those lines are and invest in things you don't know that much about, but you've got enough of a history that you have enough confidence to invest in them. I'm not suggesting ostrich farms and the latest bottom of the harvest schemes, but there are certainly some large cap international equities is one of the main ones for Australian investors that just is an underinvested category.
Okay, sure. And I guess obviously doing that higher level of research rather than just getting a few hot stock tips in which you're sort of throwing the bulk of your retirement savings, that's is something that people need to think about, isn't it? So obviously having the time to run one properly, and I sort of touched on it before that there is a sort of a bit of excitement and hubris in kicking one off and setting these things up and getting them going, and then the years go by and maybe some kids or grandkids start appearing, holidays, and maybe work starts to to elevate a little bit, and that then reflects in the amount of time you've got to sort of sit down and run through your fund and have a look at how things are performing and what direction is it going in, what's to invest in next. Would you agree?
Yeah, absolutely. And it's obviously a lot easier for me now. I'm running my self-managed super fund through Nucleus. But I've worked at a number of different places where there's sort of, you've got compliance constraints, but you're also out actively with your day job, and it's very easy to take your eye off the ball on your own investments and actually just not have enough time to spend to do the work properly to get to what you're looking for.
Okay, sure. And look, what we've done is we're breaking down a couple of key parts, I guess, for those at home that maybe are feeling like they have sort of let their SMSF sort of drop by the wayside, and they are and obviously maybe viewing today is a bit of an indicator that you are looking to make a couple of changes. So here's 3 quick changes that you could have a look at. So one for mine is an investment strategy. It's just looking holistically at the levels of risk that you're taking on board within your fund, and quite often that's just the balance of equity investments versus what we call defensive investments, which is your term deposits and cash and bond investments, and sort of working out, I guess, big picture, what part of life you're in, and how does that relate to the the amount of growth assets you should have and the amount of volatility you can expect. Typically, when you've got a longer time frame or a greater appetite for risk, and you can take on more of these equities, and then as you're moving sort of closer to retirement, you are typically winding back that risk level and looking for a more income focus. Our next one, of course, is rebalancing, and this we sort of touched on before. This is pretty evident out there, particularly with frothy markets as they are at the moment, where certain assets in your pool asset classes start to become overvalued, or they start to take a larger piece of your pie, and then you need to set some perhaps basically some intervals, and it might be an interval based on time, it might be an interval based on percentage, where you say, okay, well, look, this is where I'm going to start, trimming some fat off the table, so to speak, taking a few wins and throwing it back in there. Thoughts on this one, Damien?
Yeah, and it's the part where your risk grows because one of your assets has performed really well, and if you sort of got 4 different assets and they're all going to, over the cycle, they're slightly out of sync with each other, but they'll grow at a similar rate. So let's say we're talking Australian shares versus Aussie shares, is that over a 4 or 5 year period, you might find international outperforms the Aussie by 200 or 300%, and so all of a sudden, if you haven't done anything, it's now making up a huge proportion of your portfolio, and it'll have its turn. Australian shares will have their turn, so it's a question then of saying, well, I need to rebalance back, but it's most people have this whole set and forget, and I've invested in that, and that's where it goes. And so if you've got sort of these boundaries that you've put on your portfolio to go, well, I won't let it get above this level, or I'll make sure that here's my upper and my lower bounds, so that you can actually rebalance, take the profits from the strategies that are working well and put them into some of the other strategies, or at least even on your contributions, saying, well, my contributions as they come in, here's where I want them to go.
Yep. Okay. And I guess this plays quite nicely into our final sort of little takeaway, I guess, which is valuation discipline. So do you want to just fill us in on your take on valuation discipline?
Yeah, sure. And so that all keeps coming back to that point about what's the relative spread between the two assets that you're looking at. And so if bonds are yielding 2% and you think you can get 6 or 7 from equities, is that enough of a gain? And then when your equities, the valuation of your equities keeps going up, and maybe your bond value, the bond values come down, and so now I'm getting a yield of 3 or 4% on bonds and 4 or 5% on equities, is saying, well, just a minute, I can actually get almost risk-free, get a return that's similar onto something that's got a lot of risk in it.
Yep.
And so then I should be switching back. And so that's that same, I've got to set some boundaries about just looking at the rough valuations or rough yields is often the simplest way. There's lots of different ways to look at it, but at least having a look at it on that basis, so that you can make the decision. And let's say residential property at the moment, for a lot of people, on a net basis, the yields might be 0.5% or less than 1%, is actually coming back and saying, well, I can invest in a government bond and get a 3% return, or do I invest in this asset that's
got significant downside for the same yield,
and I'm getting a third the yield.
Yep, so. Sure. Very good. And then I guess as our fourth mistake here, we've listed bad timing. This is a Damien one. I think we'll get Damien to run through his thoughts on the bad timing.
Yeah. So this is this is just from studies that the average retail investor underperforms by about 2% per annum, which is a significant thing. And this is not most of this just comes from literally selling low and buying high. The time when everyone feels most comfortable buying is when markets have just had a great run.
Yep.
And they feel most comfortable at saying, oh, great, this asset's doubled, or it's doubled. That's a sign that everything's fantastic with it, and it's a sign for me to go put more money in, which is often the wrong way around it. And the amount of times I've seen, especially in stockbroking side, is the amount of times people have put $5,000 into a
speculative
stock.
Yep.
That's then turned that into $20,000, and then they've gone, wow, that's fantastic. Here's 100, and then next thing you know, that you've lost all your gains plus more.
Yep.
And so don't mistake that performance for being a sign of quality.
Okay.
Sometimes it is, but sometimes it's a sign that, hey, this thing's overvalued.
Sure. And reducing the opportunity set here.
Yeah. So, well, this is actually just this is mislabeled. This one. This is actually just an indication. So this is from Morningstar, and it's just sort of showing that average 10-year returns in these different asset classes in the US, and how so US equities, the average investor underperformed by 1.7%, whereas and then in international is sort of 3% underperformance. This is over sort of a 10-year period, literally just from bad timing in terms of saying, markets ran up, they bought more, markets fell, and next thing you know, they were clearing the market. And we saw that, financial crisis, a lot of people at the bottom of the market, that was when they sold out. I'm never coming back to equities again. It's, and it wasn't until 3 years later when markets had doubled or tripled that it was like, oh, okay, now I feel as if now it's time to put my money back in. Yeah, right.
Yep. Yeah. Okay, very good. And finally, I guess our fifth mistake, and this is a pretty rife, I think, in self-managed super funds. In certainly in my experience, been trying very, very hard over many years to try and correct this, but under diversification. And so, look, if you like, well, Damien, do you want to just run through, I guess, your thoughts on the typical Australian portfolio?
Yeah. Now, this is a very common portfolio. It's not I have made this to illustrate a point, but there's a lot of investors out there who do have some cash and term deposits, residential home of their own, investment property, got some bank shares in there, got some hybrids and a corporate bond ETF, and sitting back going, well, I'm pretty nicely diversified. I've got 6 different classes.
Seems like it, doesn't it?
Yeah. And in the end, you've taken 6 different bets all on the Australian housing market. And so sort of moving into that, I mean, obviously your residential property and your investment property makes sense as to I've taken a bet on the housing market.
Yep.
But if you look at the Australian banks, the loan concentration of residential property as a proportion of the total loan book is well over 60% in the Aussie banks, compared to somewhere like the US, it's sort of more like 30-something%. Even somewhere with quite an inflated property market like Hong Kong with sort of 15%.
Yeah, well, yep.
And so the thought there is, well, you've got your cash and deposits sitting with an Australian bank that's very leveraged to this, and you've also invested your shares, which is in an Australian bank, which is very leveraged to the Australian housing market.
Sure. Yep. And what about hybrids?
Yeah, hybrids.
We might just quickly need to run through what a hybrid is, actually, for those that aren't aware.
Yeah, so hybrid is they're listed entities, and it's a type of debt that is listed on the stock market. They often pitch it on the yield. They'll say so CBA, Commonwealth Bank has got some pearls out there, which are some of the most bought ones, and they'll pitch it and they'll say you can get a 6% yield or a 5% yield or whatever it is, and that's the selling point. The issue with it is institutional investors don't buy these things, and the reason why they don't buy them is because they've got all the upside of debt, which is no upside, and most of the downside of equity. So what you usually want your debt instruments to do is you want them there when equity markets go through troubled times and the economies hit recessions and things pull back. You want that side of your portfolio to lift up. So you want that to provide you some stability, and hybrids don't do that. And as we saw financial crisis, when everything hit the fan, these things traded down significantly. So just at the time when I really wanted that income part of my portfolio to rescue me,
these are taking a dive as well.
Yeah, and so and the sector's chock-a-block full of banks again. So if you're invested in a range of hybrids, chances are you've got a bunch of banks in there.
Okay, sure. So look, if we step away from hybrids then perhaps and just look at bonds, another form of debt, surely these are okay, aren't they?
Yeah, and generally they are. But having said that, the Australian corporate bond market is not deep at all, and it is dominated by, once again, the banks. And so if you bought one of the first exchange traded funds out there, this Russell Investments Australian Select Corporate Bond ETF, you go, that sounds good. That'll cover me for that. The fees aren't too high. And then once you actually jump in and look and you go just in the top 10, you can see that 80% of it is banks. And plus that, you've got an extra exposure to Telstra. So, if the Australian housing market, if you've got that, that portfolio and the Australian housing market tanked, then basically every single asset in that, diversified portfolio that we saw at the start leveraged to that housing market.
It's going to correlate quite nicely.
Exactly.
That's not ideal for something that's supposed to sit on the other side of your portfolio. While we're on the topic of correlations, actually, do you want to run us through these the US stock bond correlations?
Yeah. So this is the issue with a lot of those those efficient frontiers, and a lot of the theory that sort of goes into how do you make a portfolio, all comes back to one assumption, which is what is the correlation between these two assets. So when I say correlation, I mean that if one asset's going up, the other one's going down, then they're negatively correlated. Yep. And if they're both going up together in sync, then they're positively correlated. And the closer to one you get, the closer to perfect correlation you have.
Closer to just choosing one to invest in rather than both.
Rather than both, yeah. So ideally, you want things that aren't correlated in that. If I can have a mix of 5 or 6 different assets and they're all going up at 5 to 10% per year, but at different times. So one year it's one going, next year it's the other one going. Then my end result is a nice smooth ride for my investments. And if anything happens and I need to pull my money out, or I need to use that money for things, I don't have to worry that I've had a big drawdown because I've only invested in one asset class, which doubles one year and then halves the next year. So so the idea is I want to try and find different correlations. The problem is correlations aren't constant. So when you look back over time, now this is showing US stock to US bonds, you can see they're usually negatively correlated over that long sort of 1900 to 2000 type period. We had this negatively correlated. From then, we've actually had a lot of positive correlation within it. Now, I'm personally of the view that a lot of this has been the falling rates, and that and we've had this quantitative easing that's going on, so that this correlation is destined to be a negative correlation.
Yep.
But you can go through periods where the correlations turn positive. And one of the problems that during the financial crisis, most people complain, a lot of hedge fund people were complaining about, was all correlations went to one.
Yep.
So everything fell at the same time, which wasn't completely true. Government bonds were the asset that was rising.
Sure.
The thing was, government bonds are not a sexy asset. They're not something that you could, they're
not hedge fund material.
They're not hedge fund material. Yeah, that's right.
So do you think, obviously you touched on before with QE and falling rates is sort of probably largely an external sort of factor that's mucking around with the correlations in the short term? Is this sort of your thinking there?
Yeah, certainly for the US stock bond ones, I do think that's the case. I do think for some of the riskier assets, you will find correlations will be close to each other. So on the next slide, I've got just a recent one of just a whole bunch of different ETFs, and so the green ones are the most correlated ones, and the red ones are the least correlated ones. But it sort of gives you a rough guide for some of the factors. Just if you're investing in, say, commodities, they are not particularly correlated with other assets.
Okay.
And you do find that the treasury bonds, which is government bonds, those ones will not be correlated with other sort of assets like your share market funds.
Yep.
And those ones.
That's quite a handy little chart there, actually.
Yeah, but keep in mind, and that's I guess the point from the previous one, is these correlations do change. And most when you see strategic asset allocation, or you see these efficient frontiers, they're all based on correlation matrices, we call them. Okay. And the problem with those correlation matrices is we don't really know what the correlations are. And so it's sort of that part about with some of these things, we're from my perspective, you do need to have some of the tactical views and to be saying, well, at certain points in the cycle, I should be buying more Australian or more international shares. And right now, I think it's more international shares.
Okay. Fantastic. All right. And just while we're on the topic of asset allocation, I might just give a quick plug to a whiz-bang new calculator that we've rolled out on our site. It's for people that are choosing the self-directed path, which is typically for a self-managed super fund who is looking to perhaps reweight their exposure to defensive and growth assets. It's available at portal.nucleuswealth.com. If you haven't made a login there, you feel free to move over there after this and check that out. Look, one of the things it does here, I guess, is it gives you the ability to plug in some assets that are in your fund as of today, and then have a bit of a play around with where you'd like to sort of go. So we've got the ability. It's quite granular. You can opt to manage any assets in the fund yourself and sort of lock those up. You can also choose from the Nucleus Wealth Tactical Fund Suite as well if there's something in there that you'd like. But then what it does is it gives you the ability to say set some weighting. So you might find, and look, this might not be immediately apparent, and maybe when you plug it into the calculator, it is that you are perhaps more conservatively invested, or likewise gives you the ability then to correct that in this calculator, and then tweak some bits and pieces. You can choose the amount of international and Australian shares that you're holding, and then what it does is it'll run through and give you a bit of really some guidance on where you're going in vis-a-vis investing with us. We've also got the ability to pop in any direct property holdings as well. We're not providing any calculation tools for property holdings, but you've got the ability then to get a snapshot and a pie chart of where you're going. We've put this together, just recently rolled it out. We're quite proud of it, but we're also happy to take any feedback if you'd like to have a go and let us know from a real-time level, and from a customer level, how that's going and what we can do to make it better. So we do appreciate any feedback. And I guess just recapping now, Damien. So from the Nucleus Wealth's perspective, what do you see as our best practice for asset allocation in SMSFs and broadly in people's portfolios?
Yeah, so once we've established the risk levels and the income levels that we need, I sort of think of these four things as building blocks to your portfolios: your cash and term deposits, your Australian government bonds, your Australian large capitalisation stocks, and then your international large capitalisation stocks. So that should be sort of a core of your portfolio, and that's there to provide that diversification for you, provides you some stability in terms of your cash deposits and your bonds. Yep. If you do see recessions or markets come back, those are the assets that'll be steady or rise. And whereas your stocks are the ones where you'll get great growth over the whole cycle, but you will go through periods where you get some big drawdowns and some large rises within that area.
And hence the research of those individual stocks, and also the amount of exposure to the various sectors and local and overseas is paramount.
Absolutely, yeah. So that's what we offer as part of ours. But you can get exposures to those same assets through exchange traded funds. You invest in the direct assets yourself. It's a choice of how you want to do it. And then around that is then when you put these optional extras, and you'd say, well, if I'd like commodities, or if I'd like direct property or corporate bonds or whatever, that's what I can now invest around that sort of core holding. So you feel as if I've got that, you've got your diversification, you've got your sort of central portfolio, and you're not reliant upon the fact that emerging markets have gone up particularly or down particularly in any one period of time to provide you a total. That's your sort of your icing on the cake as opposed to that part of that core.
And I guess essentially it gives an investor some freed up time really to focus on areas that might be of interest to them, rather than having to do the whole piece of the puzzle.
Absolutely. And from running my own self-managed super fund, I do find, and certainly when I was not talking about now, because now I get to run it as a day job. That's nice and easy. When I sort of had other day jobs and things like that, the problem I generally find is when you look through a portfolio of stocks and you've put them all together yourself sort of one by one, and you think, gee, I really should take some top off the market because I think the market's a bit expensive at the moment. It's often hard to find exactly the stock you want to sell, or the best ones that you're sitting on these big capital gains.
They look good on the portfolio.
That's right.
They're confirming that you've made a good decision.
Exactly. Some of the other ones are the ones that have gone down. Oh, I know that stock's going to come back. I don't want to take a loss now because it's everything's just about to come good for it, and you often end up don't trading as much as you'd like. And so that's where I really find, from a behavioural point of view, having this core and satellite type view really does help in terms of that. In that, if you're going to stick a fund of money with us, that's great. If you just want to stick it in an ETF, that's just as good. But at least though that ETF, it's quite easy to sell. You don't have the same emotional attachment to it. Yep. You think the Australian market's toppy, you can get rid of that get rid of that ETF that sits in the middle, or get rid of the Nucleus funds that sits in the middle. And if you want to hold on to some of those other stocks that are around that, where you've got the emotional attachment, is it's a bit easier. And you also find that you can put, as you said, a lot more work into those other ones where you're saying, well, I've got you might have a biotech bent or a resources bent. You can go and research the ones that are going in that, but it'll make up a smaller percentage of your portfolio, and it's not going to make or break your retirement.
Yep, Yeah, well, that's very apt, I think. And it's like anything in life. I think you always do the stuff that you want to do first, and then if there's any time left over at the end, you'll do the boring stuff. And particularly, as you say, with something as important as your retirement nest egg, it does warrant a more balanced view. So, well, in interest of time, actually, I just noticed with this one's gone a little bit longer than we thought, but that's fine. We'll leave question and answers for email if you like. More than happy to work with you over email, or if you'd like to drop us a call or book a call. But I will just quickly drop through what we do every day. So obviously with at Nucleus Wealth, we use a separately managed account, which we've chosen because for a number of reasons, but one of the key ones is that it gives people, or gives our clients, the ability to hold individual share portfolios in their own name, or in the name of their super fund in this case. And obviously get the benefits of those holdings. So, things like the franking credits, certainly from a tax perspective as well. We've chosen Linear as our platform provider, who provide the services basically for the separately managed account. They're backed by, from a cash perspective, the ANZ Bank, and from a custodian asset holding perspective by JP Morgan, one of the biggest investment banks in the world. We also, just as something a bit different, I think we offer a selection of 19 different ethical screens that you can have on our portfolios. So we go out there and we try and invest the best that we can every day. But if you've got a particular ethical bent or theme or feeling that you don't like a certain area, then we've got the ability to then screen companies that might be involved in that ethical theme, essentially, out of your portfolio for you. So it gives you quite a granular control over that, and I think that's been resonating quite nicely with SMSFs who typically invest, in or create SMSFs for a control reason. So outside of the ethical screens, we've also managed to bring a product to market that has significantly lower fees than a lot of our competitors, and a lot of that's because we've been able to remove the multiple layers of middlemen between your money and basically you. So through doing that, we've been able to create this quite a cheap product. We think it's quite marketable, and we hope that certainly from the feedback we've been getting, everyone's been pretty happy with it, which is good. We've got the complete transparency of having those share portfolios through the separately managed account, and as I mentioned, there's the tax benefits as well. Coming up, so this is our final webinar for the year, but we will be back in force on the 18th of January. It's the same bat time, same bat channel at 12:30, and we've 12:30 p.m. and it's entitled "Will 2018 Trump 2017?" Now, there's probably some conjecture as to whether or not he'll actually be in office in a couple of weeks' time. But Damien, David, and myself will be sitting down to discuss some of the impacts, I guess, and the factors that our dear American president has had on the markets, and I guess what's in store for the world, and in particular US markets in 2018. So we look forward to your attendance there. If you'd like to book your attendance, just head over to proton.nucleuswealth.com. And just finally, we will be sending out, as always, Maddie, our communications expert, will be firing out a quick bit of feedback, a couple of question form that you can help guide us, as you have today, actually, with today's topic, on where you'd like to. What sort of topics you'd like for us to present to you going forward, and also some feedback on how we've gone today as well. So on that note, thank you very much for checking us out today, and I hope that it's been pretty factual and given you a few points to go away and perhaps do some of your own summer cleaning, summer review of your self-managed super fund. And of course, if you'd like to talk to us, feel free to book a call or drop us an email. So thanks again. Cheers.